This is David Goldman, Asia Times Deputy Editor, speaking to you from New York on May 26th. Well, stocks are locked in a fairly even balance between fear and greed. The entire Fed course was out again telling us that inflation is transitory. So stocks went up a bit after they went down yesterday when they thought inflation perhaps wasn't going to be transitory. You know our view, be afraid, very afraid of inflation. It's very interesting that the gold market is starting to show more of a fear gauge about inflation. Now, if you look at the chart of the day, basically you'll see that the gold price tracks the yield on inflation-indexed U.S. Treasury bonds pretty clearly, and that tracking divides neatly into 3 periods since the beginning of the COVID crisis. On the right, gold was pricey with respect to tips. That's when it looked like the world was coming to an end between January and August of last year. Then in the middle, there's another trend line. That's kind of neither here nor there. And on the left, there's the trend line for January through May of this year, where gold has underperformed tips. Gold looks fairly cheap. Now, gold broke the 1900 mark today, which is important. And there's a reason why gold should outperform in the future. In theory, inflation-indexed treasuries and gold both serve the same function. They're a protection against a surge in inflation above and beyond what the market currently prices in. But there are some bad things about tips that don't happen to gold. For example, when the Treasury pays you extra coupon payments to compensate you for more inflation, they pay you those coupon payments in U.S. dollars. What if the U.S. dollar is tanking? Particularly for the foreigners who own roughly a third of Treasury securities outstanding, that's not particularly attractive compensation. And there's another thing. The Consumer Price Index, which is the Bureau of Labor Statistics' official gauge of inflation, is not terribly accurate. We pointed to the fact that shelter inflation is out of control. Housing prices are up 13.3% year on year. And rents are up, according to the government's own measure, about 17% year on year. But the housing component of the Consumer Price Index is only up about 2%. We expect it to converge over time, and that's one of the reasons we don't think inflation is transitory. So for the moment, we continue to like securities that benefit from inflation. Banks are an example. Oil is an example. And we would add a bit more gold to the mix as an inflation hedge. This is David Goldman speaking to you from New York City on May 26th.